Hello, welcome to Taking the Biz, the place to head for A-level business revision tutorials. In this cheeky young video, we're going to take a look at how entrepreneurs might solve liquidity problems inside their organization if they've constructed a cash flow forecast and found that there may be months of the year where they might have a negative closing bank balance. Now, this is a very common experience for new business startups. When you first start a business, your costs are likely to be higher than they may be later on in the organization's existence, because you've got all of those startup costs, the equipment, the raw materials, the training, the initial marketing that might be lower later on during the course of the year. And you also imagine that when you're first starting an organization, your income, your cash entering the business might be lower when you first start than once you've become a little bit more established. So it's very common for businesses to predict or to forecast that there might be months in the year where their business is going to spend more cash than it makes, and they might not have enough cash in their bank account to cover that difference. Now, if that occurs during the course of running your business and you haven't foreseen it, that can be problematic. That can mean that you might not be able to meet all of your financial commitments, so workers might go unpaid, or you might end up not being able to pay your suppliers on time. You might even not be able to pay back a bank on time for a loan that you have taken out. That's problematic. So cash flow forecasts are really useful for highlighting months where we might experience liquidity problems, but if we do spot it in advance, how can entrepreneurs try and fix the problem? What can they do in advance of this happening to try and make sure that it doesn't derail the running of their organization? Well, in essence, when you're trying to solve cash flow problems, when you have shortages of cash or liquidity problems in an organization, there are only really three ways that you can try and soothe the problem. The first way is if you spot in advance, months in advance, that you may run out of cash during a month, you can try and take action early to increase the amount of cash that you might have coming into your business during the course of the month. Take a look at this cash flow behind us. We have got liquidity problems during the months of January and February. During these months, we're going to be spending more cash than we're going to be making, and we don't have enough funds already in our bank account to cover the fact that we're spending so much money. So an entrepreneur could try and stop this situation from materializing by trying to find a way in advance of increasing these cash inflows. This might not actually materialize if we can find a way in advance of boosting the amount of cash we make in January and February. So that might involve, if it's an existing business, trying to bring forward the payments of our customers, shortening trade credit periods that we offer to bring cash into the organization sooner. It might involve trying to boost our revenue, potentially by making changes to the prices that we charge. Maybe we're going to charge more and try and bring in more revenue per sale. Maybe we're going to try and charge less for our products in order to try and attract additional clients to the business and make greater amounts of revenue. We should not be suggesting making changes to our pricing, though, without first acknowledging that what we do with our prices will depend on the price elasticity of the goods and services that we're selling. But that's the first way that we can try and soothe liquidity issues. Try in advance of thinking of a way of bringing more cash into the organization. The second way of trying to solve cash flow shortages is the opposite approach. Maybe we might be able to try and find ways of reducing the amount of cash we might have leaving the organization during the course of a month, so we can try and prevent these shortages of cash occurring by trying to reduce some of our cash outflows. So maybe we could look at things like trying to reduce non-essential expenditures. Maybe we could bring our marketing budgets down. Maybe we could think about trying to switch to a cheaper supplier to bring down those raw material costs. Both of those two options will have their own impacts though. If we're spending less on marketing, it might mean that our cash inflows are lower because we haven't advertised the business. If we change suppliers, it might mean that quality suffers. It might mean that we don't make as many sales because what we're producing is not as high quality. So those do have some issues attached to them, which means that the most common way for entrepreneurs to try and solve the cash flow problems that they might predict for their business is not to try and increase the amount of revenue they predict they might make, and not to try and reduce the amount of cash they think might be leaving the organization, but instead to try and soothe or fix this situation through some form of finance. So the most obvious, perhaps the easiest way of trying to solve liquidity problems is to arrange a facility with the bank known as an overdraft. If we have a cash flow forecast that shows us that we are going to end January and February in the negative figures, but if we can show a bank that, hey, look at our cash flow forecast, by March we will be back into the positive figures again and our business will really be bringing in more cash than it is spending, we may be able to arrange an overdraft facility. We can visit our bank and say, hey, if you can give us an overdraft to see us through periods where we're struggling for cash like January and February, then by the time we're back in March, we'll be outside of our overdraft, and a bank is likely to be able to provide that facility for a fee for an organization. For businesses that have a closing bank balance that is a high negative number, it might be that they can't achieve or obtain an overdraft for an amount that would cover that. So instead, they could try and seek bank loans to cover the expenditure of items that might be very expensive for the organization. For example, look at these cash outflows of January of £600,000. It might be that that is to try and purchase some startup machinery or equipment or vehicles for the organization that are a great expense. Rather than trying to cover that through the cash that's entering the organization, maybe the entrepreneur could take out a bank loan to cover the cost of some of that expenditure, bringing extra money into the organization in January and potentially helping to prevent some of those cash flow shortages from occurring. So when we're trying to fix cash flow problems, there's three different avenues we can go down. We can try and in advance think of ways of bringing extra cash in, or in advance be proactive and try and prevent additional cash leaving the organization. The most common approach is to try and fix it through some kind of form of finance, probably through an overdraft in extreme situations, maybe even a business loan to cover some of those big expenditures. Common question for the exam. Students are revising cash flow forecasting and looking at how they calculate them. Then they get thrown in the exam with a longer answer about how we can solve cash flow shortages. Hopefully that video will help you answer those questions. We'll see you soon for some more revision. You keep on taking the biz.